Bismillah ar-Rahman ar-Rahim, and good morning, everyone. Thank you very much for joining our important webinar today on fundamental analysis, the macroeconomic outlook. I'm very glad and proud today to have our speaker, Dr. Jossan, Senior Fellow in Higher Education and Assistant Professor in Business Studies, Stenden, Qatar University, and she is also the chairperson of admissions in the university. Dr. Ano also, by the way, she was the academic supervisor of the team who won the second place last year for the QSE financial education competition for universities. So I'm always happy to see her and discuss with her. It's always very useful and beneficial to me that I learn from her. So I believe that today's webinar will be very informative and useful for everyone, and we all will enjoy Dr. Ano's presentation and discussion and her answers to the question. Before moving the floor to Dr. Ano, please, I just have one point. If you have any question, please do put it on the question and answer section, not on the chat section, because for me, it's easier to track the question on the question and answers in order to be able to answer them, inshallah, after the presentation. Now, it gives me great pleasure to move to Dr. Ano. The floor is yours. Doctor, please, you can start now.
Thank you, Sama, for having me here. Good morning, everyone. I hope you are all staying safe and sound in your respective places. And I thank God that we are actually privileged amidst what's happening around in this world, that we are safe and sound. And so today it's my privilege to be part of Qatar Stock Exchange webinar series and share some of the thoughts on fundamental analysis, which can help you make a better investment decision. And I'm really mindful that the audience is varied, because I know there are some traders, there are experts, there are people who have never invested in life and who wants to invest, who are completely new to this. So I will try to strike a balance between these two types of audience, like who are really knowledgeable and who are not that knowledgeable. So I'll be like a teacher. I'll be explaining the concepts in simple terms, connecting the real life, and also be using some of the jargons, but surely with explanation. Now, I would like to call this session as informed investment decision. So the objective of this session is to help you to make informed decisions and understand how in-depth and how wider your knowledge should be before you take any investment decision. So that will make you more prudent and on decisions on investments. Now, fundamental analysis is one approach, one type of method, okay, to analyze investment decision. There's another approach called technical analysis. Someone has given in an introduction about technical analysis. So he told that there will be webinars coming up on technical analysis. So if you want to know better about technical analysis, that's more of charts and symbols, you can join those webinars to understand. So today our focus will be on fundamental analysis, which I have divided as microanalysis and macroanalysis. So microanalysis, I would call it as a worm's eye view, like in this picture, like how you see, okay, in a very specific format and very specific to certain factors, for example, a company, okay, and its variables. And also, the macro analysis is about a bird's eye view. Now this is not the terms which I have found out. It's usually the economist, usage of these terms. So macro analysis is more of a bird's eye view. So it's not more onto the specificity of factors, but it's more about the wider picture or the broad picture. Okay, so which the company get influenced by. And I believe that these two aspects contributes a lot for decision making, and it's very important that you understand both the concept. Now, to start with, why do you invest? Now, we invest with the view to build our wealth because we know for a fact our jobs are not safe, or our regular income may not be sufficient, or, maybe our regular income will end after some time and we need to retire from our job. And also the cost of living is increasing, and we might be having many financial goals wherein we need to invest as well, and we need to secure our future. So with all these goals in our mind, it's important that we invest and make other streams of income other than our salaries. And through these income streams, whatever we get as income can be in the form of interest, or in the form of dividends, or in the form of some capital gains, okay? And this is how it helps us to generate wealth. And the idea is not to just save, it's to, invest the money, okay? So most of you might be saving the money, that's a good habit, but because your income, whatever you get as salary, you can consume or you can save. Saving is a good habit, but that will not increase or generate wealth. So whatever you save, you need to invest, and whatever you invest, you need to reinvest. Okay, so that's what the point is in this particular slide, which I want to bring. Now, the few investments which you can think of, first of all, we all are familiar with bank deposits, like the savings and the fixed deposits. For example, like wherein you invest money in fixed or the call deposits or the demand deposits, where you get a little amount or not that great amount of interest. Okay, and there are bonds and debentures, there are equity, there is forex trading, mutual funds, and derivatives. Now, all these investment arenas and investment opportunities which you have, okay, it's based on, one term, which is ownership. For example, some of the investment, you are lending the money as a lender. That means, like you are giving the money to the government or a company or a corporate as a lender, and they use this money for their projects or something like that. But there are investments where you get ownership as well. For example, equity, okay, here in equity investments, here the equity is a partly ownership kind of investment. So wherein you are investing in a piece of a property or through mutual funds or through real estate, at the same time, you will also get an ownership in the company, okay? And with this ownership, you have some influence in the company's business, in the company's decision-making process. Now here in the bonds and debentures, this is completely the opposite of equity investment. Now in equity investment, you buy shares of companies, okay, and become, a part owner of that company. Bonds and debentures are issued by governments and corporates, but they are not going to let you be the owners of the, you can never be an owner of a government or a big corporate through a bond and debenture. So bond and debenture are issued as debt certificates. That means, like they use it as a certificate to show that we have taken money from you and we are going to pay you some charge, some, benefits from that, maybe some interest or some yield from it. So this is it. You don't have any ownership, but you get some money for that investment. So these are the main difference between bonds and equity investment. Now, the difference between bond and debenture is that bonds are usually backed by an asset, okay? And debentures are not backed by an asset. So the companies, when they back it, so if something happens, the bond is always backed by an asset, but debenture is basically based on the reputation of the company. So most of the people who invest in debentures are sure of how good the company is and how credible the investments are. But both these bonds and debentures are, less risky compared to equity investment because that's not volatile, okay, compared to equity investment. And it is a fixed income source. It's a fixed investment, a fixed instrument. Now, foreign exchange trading, you all know about it because most of you, or many of us, are living in different countries. We know about the foreign exchange of currencies. And some of the traders, some of the people who invest in this benefit of exchange value and use it as, as in terms of trading. Okay. Now, foreign exchange trading is one of the biggest market in the world wherein people invest and earn money because of the fluctuation in the exchange rates. And there are a lot of types of strategies in the forex trading. The other type of investment you can think are the mutual funds and the ETFs. Okay, and these are investments derived out of shares. Okay, and these are exchange-based traded funds, and also the mutual funds are managed by a company, and you will have an index of a group of shares, which can be risky or not risky, or not, that, you know, based on the capitalization, based on the risk, you know, you can choose different types of mutual funds. And then you have derivatives, and derivatives are, you know, like not that famous like equity or the mutual funds or the other types of investments, but these are derived from a particular thing or a commodity, like an oil or a you know, for example, an index, or based on silver or based on gold. Okay, so these are investment in commodities market, and these are dependent, these type of investments are dependent on any volatility or any fluctuations that affects you know, these type of markets. So the underlying asset of a derivative is a commodity. Now, with this, I would like to go to the next screen about informed investment decision. Now, I have explained to you why we invest and what are the different types of, you know, these are not the full list of investment, you know, opportunities, but these are like the main types. But how do you make informed investment decisions? So in the beginning itself, I told you, saving the money is not the act of investment. It's just the preliminary of investment. So you are the investor, okay? And on the other side, okay, there is someone who needs the money. So you save the money and you give the money to those people who are in need. And in this case, these are the corporates or the companies or the governments who need money and who are willing to pay you for you giving the money. Okay, and so you earn from it and earn from whatever money you give. So you save the money, and whatever you save the money is from your regular income, and you can earn more money and you can create more wealth by investing it at the right places. So we make wrong decisions as well, you know, like we can go and invest in wrong places and can really make wrong decisions and can affect our wealth. So it is very important that we be informed, okay, and we have all the facts and information, and also use the all available data to analyze and manage this investment. Because at the end of it, credibility of investment matters for earning. If an investment is not that credible, if a company is not credible, if a particular asset is not credible, and if you are going to invest in that particular asset or security, you will end up in losses, and huge losses. So it is important that you be watchful about where you are investing, in what you are investing, and when you are investing. And that's why data will help you to give you enough information about the facts available in the market and also from the environment. So as I told you, fundamental analysis is one type of approach which can help you to make this informed decision, which can help you to analyze the data, which can help you to improve your decision making based on the available facts. And based on this, you can make more prudent and informed decision. Now, in fundamental analysis, from the word itself, you can understand it is about fundamentals. It's about the root. It's about the basic, and it's about the economic and financial and other qualitative and quantitative factors related to the investment. It's not about the trends, which we learn about, you know, mainly in the technical analysis, but it's about studying about the main factors or the basic factors related to it. So through this fundamental analysis, we learn microeconomic factors and macroeconomic factors. Now, microeconomic factors, as I told in the beginning, it's more of a worm's eye view. That means it's more of specific, you know, like about the financial condition of the company, the management of the companies, how good the company is performing and functioning. But in terms of macroeconomics, it's about the overall economy. That means, you know, if you take a plant, the condition outside the plant, that means the weather, the, you know, for example, the wind, the air, water, all these factors, you know, that we need to analyze the quality of that as well for the growth of this plant. So these are the macroeconomic factor. So by this fundamental analysis, it will help you to find out what investment we should build on. And does it have a shaky or a strong root, okay? And does it have a prospective foundation? And for that, you need to explore more and more variables of microeconomic and macroeconomic factors. Now, if you see the fundamental analysis as an approach, it's called top-down approach, which is called the macro, and then the bottom-up approach, which is the micro. Now, in top-down approach, what exactly happens is that you start or you focus on the economy analysis, because the economy is an environment in which all the businesses function, all the industries function. This is the ultimate factor which can think, or which can make you think that whether the business has a future or the business is going to collapse. Now, take the situation of COVID itself. Now, with COVID-19 situation, we know that before that, in 2019 was the best year for all the equity investments and all the Bitcoins or many markets, Forex trades. After the 2009 global crisis, this year, 2019 was one of the best years for many, many markets, including many economies. But soon after we got hit by the COVID-19, what has happened? It has led to an uncertainty. It had led to a complete shutdown of business. Now, this is not coming from the internal factor. It is from the economy. It's from the bigger picture. This is called top-down approach. So you look at the economy and you see the indicator and you see whether it's going in a direction where you can invest. This is called top-down approach. Now, to give you a best example for this is that you might be knowing about Warren Buffett. Now, Warren Buffett is a fundamentalist, and he is, you follow his guru or his professor, Benjamin Graham, and you might also have read this book called Intelligent Investor. Okay, so Warren Buffett has clearly mentioned in one of the shareholders' meeting that he follows Graham's strategies in investment. Okay, and one of the strategies he follows is value investing. Now, a clear picture he has given when he has shed away all the airline stocks just soon after the COVID situation, because he was telling that it's not going to be safe to keep all these airline stocks, because in the future, in the coming future, it's not going to be any better. And with this decision, he just 4 billion equity shares he sold off, okay, of Delta, of United Airlines, or American Airlines. He had 4 airline shares. So he sold it off. It was based on the economy analysis. This is called a top-down macro analysis. And we can also see another approach called the bottom-up micro approach. In this bottom-up micro approach, we make investment decisions by checking the fundamentals of companies first. Okay, now checking the fundamentals of company first means, this is not about the economic scenario, it's about the performance of the company. It's about how this company has performed in the past, how is it performing now, okay, what kind of strategies they use, and what's their position, are they creating wealth, okay, so this is based on more of company's performance. Now, every business is affected by myriad of factors. It's not only this internal factors, or it's not only the external factors only, because all these companies are not working in a vacuum. It is working in an environment where there are dynamic factors which move from one industry to another, which affects economies, which affect business. So it is part of a larger entity, okay, to know as a business environment. So it's very important that you do a top-down macro analysis, and at the same time, you do a bottom-up micro analysis as well. So in this webinar, I'm going to focus on, micro a little bit and more about the macro aspects. Now, when you think about the micro bottom approach, okay, what exactly you're going to look at? Okay, so you're going to look at the future of the profit outlook. And how can you know that? Okay, you need to do a company analysis. So how to do a company analysis? The company analysis is based on many of the financial elements this company shows. Okay. And on the other side, the macro approach or the bird's eye view, you will try to understand the industry, okay, the sector, and do the analysis, okay, which the company works in, and also see the economic factors or the economic condition wherein this company works in. This economic condition can be the national economic condition, the regional economic condition, or even the international economic condition. So first of all, microanalysis. So I'm going to talk more about the company analysis and the future profit outlook. So micro factors which affect the financial performance and outlook. So if you take a business, okay, the business has many factors. Now, every investor invests in a company, okay, to make money, to create wealth, and that is the main objective. In economics, the objective for an investor of a business is maximization of the profit. So when a management is working for an investor of a business, okay, the management is working to make as much profit as possible for the investor, because the investor is the owner of the company, right? But there are many factors which affect this business, which affects the confidence of the business, which affects the operations, okay? So first factor is the strategy. So what kind of a strategy this company focus on at the corporate level, at the business level, and at the operational level? The corporate level strategy is the most important. Mainly the companies follow three types of corporate level strategies: growth strategy, stability strategy, and retrenchment strategy. Companies who are in the number one position, they always want to stay number one, right? They don't want to, there is no other position about that. So they want to stay number one. They follow stability strategy. Okay, so these kind of companies, okay, their share prices, you can see that there will not be big fluctuation. There will not be big movement. They have already reached the top. Okay, so unless and until they go into a bigger merger or an acquisition or a bigger, a big economic shift happens, like there is not going to be a big change in the share prices of these companies. So if you take these type of companies, for example, the leaders in the market, okay, so these kind of companies will have very high share prices. So they follow a very stable strategy at the corporate level. At the business level strategy, they can also differentiate the strategy. They can do price discrimination. They can do competition type strategies or non-competitive type of strategies, but it's all based on the corporate level strategy. Now, at the operational level, they can go into merger, they can go into alliances, they go into acquisitions. Okay, these are the operational level strategies. So strategy plays a big role when it comes to the business performance. Stakeholder management and control. Okay, so in the beginning, I told the shareholder is also an owner of the company. Not only the shareholder, there are other people in the company who can influence the company's performance. Their interest and control matters. There are different functions in the company, like the sales, marketing, and the human resources. Okay, the efficiency of these functions, it's very important, okay, and they add value to the main operations, okay, of the company. Now, when it takes to the operations, how efficient and how optimized are the operations? All these factors, all these four main factors, which I just described, okay, finally result in the financial performance of the company. It impacts the position and the future outlook of the company. But at the end, you and me as an investor will only see the financial performance. All the other factors, which I just discussed, will be hidden and will not be that evident. It's like an iceberg, which is under the water. And what is outside is the financial performance and the position and the future outlook. So in micro analysis, the main indicator, okay, so every car has indicators. So indicator will show you whether you're going to the left or to the right. So as an investor, if you want to know where this company is heading to, the final indicator which you need to look at is its financial performance, position, and the future outlook. So where can you see this? You can see it in the annual report. So annual report is a main source of microanalysis. So every company, every listed companies where you want to invest in, okay, who has shareholders, public and private shareholders, they publish annual report. And this is a main source of analysis. Now, the annual report is a big book. If you have ever seen, it is a big book with many pages, say 100 pages, or sometimes, like they just publish the gist of the annual report as well, and sometimes in the newspaper. So the annual report is a main source of your analysis. Now, the annual report will help you understand, okay, what is the strategic summary of the business activities, because there is an executive summary from the managing director or the CEO or the director of the company to the shareholders about how well they functioned, okay, how was the past, what will be the future, what is the perspective of investment. There will be an executive summary. This is called a letter from to the shareholders. There is a company overview, which talks about the profile and the structure of the company. And there will be a little bit of market analysis to show that how good this company is in terms of its position and its share in the market, and also the growth. And the main thing is the financial statements. Now, most of us see it as Greek, and for us it is Greek and Latin, because financial statement talk about balance sheet, income statement, and the cash flow of a company. Now, but these are the main indicators. These are the main statements which we should use for our informed decision making. Now, based on the financial statements, there are financial analysis which you can do in terms of ratios, absolute and relative analysis. Now, financial analysis is something very important, and there are a lot of ratios related to profitability, liquidity, efficiency, gearing ratios, investment ratios, okay, but which I'm not going to explain in detail because this is more of microanalysis, and there were n number of webinars which QSA has scheduled and it will be scheduling on financial analysis. And there are notes and extra information in the annual report. Now, when it comes to this kind of an analysis, okay, what should be your next step? Okay, as I already told you, the financial statement is the primary and the most critical information which we should explore. Now, what is a financial statement? Financial statement of a company will show you where its money came from, where it went, and where is it now? Okay, so the balance sheet, the income statement, cash flow, these three there are other statement of equity, there are other statements as well, but these are the three main financial statements which we need to look at. And we use financial ratios, which I just explained, okay, and also use absolute and relative analysis to see how well this company has done. Now, in terms of the aspects within the financial statements, what we need to look at, and see, okay, what this financial statement is talking in terms of profit, revenue, and expenses, and also asset, equity, and liability. Now, shareholders can use this financial statements to assess the risk and return of their investment in this company and take investment decisions based on their analysis. Now, for example, the balance sheet, okay, which is the asset and liability and equity, will tell you, okay, how much money a company or institution has assets and has as liabilities, like how much they owe to others, okay? And it will also tell you what is the final net worth or the book value or the equity. Now, this is an important financial statement, and it will give you insights about how huge the company is, what is the value of this company, what is the position of the company, does it have big liabilities, okay, does it have cash sufficient enough to, you know, to meet those short-term liabilities, okay, how big is the cushion of equity, how big is their debts, okay, so this is one aspect of your financial statement. The other important aspect, which is the revenue, expense, and the profit, you can see in the income statement. Now, this shows you the ability or the capability of this company to generate profit. Okay, so this is the most important financial statement which investors look at, because profit is ultimately what shareholders want. Okay, and based on this, they will see what's the gross profit, what's the net profit, what's the operating profit, and what it talks. Did it grow over a period of time? Did it decline? Is it showing some prospects? Okay, so this is the most important financial statement. And finally, the cash. I have put cash in the middle because that is the biggest reality. Because profit is called as an imagination, or just, hidden truth, or, like what to say, vision, okay? But cash is a reality. Cash is the final thing which will be there in a company as net cash in terms of cash inflow and the cash outflow. So the cash will tell you, okay, whether the investor investing in this company, okay, whether this company has a strong footing, okay, because if cash is not there, okay, and if the cash is idle, having excess cash and having less cash, both speaks reality to us, Okay, having excess cash shows that the company is not investing and doesn't have any future prospects. But if there is no cash, that also shows the weakness of the company to meet short-term liabilities. Okay, so this is the cash flows in terms of, there are three activities in the cash flow, like operating activities, investing activities, and financing activities. So the investor will look at, okay, what is the amount of cash generated from the operating activity? So that speaks the truth. Okay, that will tell you the capability of the company to generate cash. Investment activities in the cash flow will tell you like how much money is being invested. So these two aspects are very, very important. And same with financing activities, like how much debt they have taken and how much debt they have paid off. So looking for positive trends in these kind of sales and revenue and profit, lesser expenses, the cost earning, the cash flow. Now, these are very important for an investor. So when you look at it, okay, the strong companies will have healthy balance sheet and they know how to manage their expenses in their income statement, and they are capable enough to make big revenue and make more profit. So for instance, fluctuating profits, it actually indicates a higher risk. For example, maybe they make a very good profit in 1 year, the next year they are going down, then again they made better, then they dip. This kind of profit, okay, it shows that the company is not that efficient. It can go to a trend. It's like an up and down trend. So look for those kind of companies which have very good earnings, very good profit outlook, okay, so as an investor. Now to go to the next part, okay, which this is just the, to show you how the income statement, the balance sheet, cash flow, and the balance sheet are related, okay, and to show you that how each contribute to each other, okay. The second aspect after the company analysis, which is a financial statement, is the future profit outlook. So now you know that you can read finance and the financial indicator will tell you about the performance and position of the company. The second aspect which you need to look at it is, what is the future profit of this company? What is the outlook of this company? So for this, you need to look at the forecasted revenue and the growth projections, okay? And these components are very important for microanalysis. Now, this can help you to tell what will be the forecast on the valuation ultimately, because based on the profit, based on the company's revenue making capabilities and efficiency, you can predict what will be the revenue, okay? And based on the revenue, you can predict the profit. And based on the profit, you can predict the growth and what will be the incremental market share, because when you gain more and more profit and more revenue, you are becoming better. The company is becoming better than its competitors. So there is incremental market share. Maybe you are becoming better. You are having, maybe this company is following a growth strategy and you are from the position of 2 to position of number 1. That's why we see many of the companies are very focused onto the market share gains. So they want a better market position every year. And this will tell you a lot of insights about what this outlook is, what the company's outlook will be. The pricing power and the calculated growth rate, okay, in terms of, like the market share, the pricing, the share prices, okay, the revenue, okay, and finally, the predicted cost as a fixed percentage of the revenue. So usually the cost, it's difficult to predict because of inflation. And every time there will be, a discount factor, which is difficult to identify in terms of inflation. So we always use cost as a fixed percentage of revenue. So if you do it in that way, it is easy to find out, okay, what the growth prospect will be. So finally, this will be ultimately affecting your forecast on the valuation of the share price. Okay, and valuation of the company's asset. Now, this will make it, if you have good numbers and if you have the revenue and the cost and all the details as much as possible and as precise as possible and as accurate as possible, your prediction will be much more clearer. You can make errors in your prediction if you have wrong numbers. That's why it's very important that you have more reliable inputs and take information from the correct sources. Now, how will the financial statement, which I just explained as number 1, and the second thing, which is the future valuation based on the future outlook, will help you as an investor to make informed decision. Now, this is a reality. The company will follow different kind of strategy. It will follow different kinds of market. It will have different functions. It will have different operation style, but ultimately the finance, the indicator will tell you, okay, how and what the position and the performance of the company is. And you can also do comparison, okay, based on the profit and expenses and the earning capability of the company and over a period of time, and also between companies to see how good this company is. And also we can see whether this managing directors are talking, you know, and staying on what they have promised. Maybe last year they have promised something and they have given a budget and they talked about bigger sales and bigger revenue, and whether they are keeping it, okay, in the future, in the performance. This is one way of tracking it. And finally, this financial statements and future valuation will help you to understand the company's strength, its value, and the net worth. So this is about the micro-analysis part of it. Now I want to go, let's see the macro analysis. So just to summarize, the microanalysis is just the worm's viewpoint. That means the specificity of a company, within the company, how it performs like that. Now let's see what, apart from the company's macro in a, side, how insightful is a macro analysis side? Okay, so the macro analysis are factors which is around the company, not within the company, which influence the company around the company. Now, macro analysis environment is very dynamic. We know that, like one part, something might have happened. For example, blockade has happened in Qatar. It has affected many businesses. COVID has happened in China. It started, having ripple effect in other countries. And also it finally affected individual and even small business in Qatar as well, and in other countries like that. So it can have big effect, very dynamic effect. And also it can be positive, it can be negative. It can give you good avenues and good opportunities for investment, but sometimes it can be uncertainties like how we are now. But within this uncertainty as well, there can be some kind of opportunities. Okay, so just take COVID-19, for example, just came as a blow. And it is not only affecting one or two businesses, it is affecting industry, it's affecting economies, it is affecting the world economy. And by knowing the impact of these incidents on the macroeconomic indicators, we will have a clear understanding about how this wave can hit your investment. And can be something positive, as I said, and it can be negative. Now, to categorize these factors, okay, what are the factors which can affect a business? I've come up with these 6 factors: the industry factor, the political factor, demographic factor, economic factor, technological factor, and I have put social, environment, and governance and the legal into ESG. So if you take industry as a factor, and now here also, the main thing which you need to notice here is that anything which affects the industry, which affects the political side, which affects the demographic and the market side, which affect the technology and the ESG, will ultimately impact in the economic aspects. So if financial performance and position are the indicators in microeconomic analysis, economic analysis within all these factors are the indicator. That's why it's called macroeconomic indicator. So this is the indicator for macro analysis. Now, in terms of the third analysis, so for the first analysis was in the micro analysis, which is called the company analysis. The second analysis was also in the micro analysis, which is called the future outlook of the company. The third analysis and the fourth analysis is the macro analysis. So this is called company's relative strength in the industry, or industry analysis. So through this, what we are trying to do is that as an investor, I'm going to invest in a particular company, okay? And I want to see whether this company come from a good industry or a good industry background, or is it, what is its relative position within the industry? How is it performing within the industry compared to others? Okay, so relative market share is one aspect of it, which you can check, okay, to see what is the strength of this company in terms of within the industry. What is the industry's production capacity? And in terms of that, what is your company's production capacity? Is it under the capacity or the normal capacity, or over the production capacity? Company's image, okay, that shows, within the industry, maybe, you have seen a lot of scams and scandals related to operations, finances, and financial transparency, lot of image problems and lawsuits and scams and scandals. So what is a company's image, okay, when it comes to the industry compared to others? And you can also watch for the certificates and the awards, and many of the achievements they have made over a period of time. Okay, so this is the company's image. This is a quantifying factor there. And you can also see the profit margin. What is the industry's average profit margin and how your company is doing in terms of profit margin? What are the technological advances and infrastructure capability in the industry, and how good is your company against the industry? What are the capabilities in the industries? Okay, the resources and the capabilities, this is one part of strategy, okay? And how well is your company in terms of the capability? What are the R&D strengths? What is the customer and the market customer knowledge related to the industry? And finally, the employee commitment related to the industry. Now, in this aspect, I want to make it very clear, don't confuse yourself with industry and sector, okay? Now, to give you some examples about it, industry is a group of companies offering similar products and similar services. For example, now if you take a global heavy truck companies, there is Volvo, there is Benz, there is Tata Motors, there is Ashok Leyland, there is Qatar. These are companies in the truck industry. So this is an industry, but this industry, this truck industry, is within an automobile sector. So the other automobile sector can be, for example, general automobile sectors are there, the Toyota, the General, General Motors, the Volkswagen, or the Honda or Nissan, these are the other industries, the SUVs or the small market like that. So all-terrain vehicle is another industry. So different industries together make one sector. So in some countries, there are only 3 sectors: primary, secondary, and tertiary. Like, for example, in India, they follow these 3 sectors, and all the others are mainly the industries. But actually, the industry is the contributive factor or is a part of a sector. So it is important that you maybe, the effect of a particular incident has affected the industry, but not the whole automobile sector. You might have seen some of the big deals that has come up in within the COVID-19 situation when Tesla, okay, so you know about Tesla, you know about the Ford and the GM and all these companies. What did they do? They have actually shut down their business. They have stopped their production. They cannot do anything. They are not producing. There is excess capacity. They have big factories. They have big machines, and it's all idle. So that's why these companies, okay, has gone into production of medical equipments like ventilators. Now they have the capacity. They tied up with many of the medical companies, and they started producing medical equipments. And some of these companies, are trying with the R&D on how to make it improved as well. So Tesla is an example, okay, which is trying to make medical equipments and the ventilators and everything, and like that. Ford, GM, all these companies got into different kinds of partnerships. Now, this term sector is often used to, as I told, a group of industries. Okay, so you can say pharmaceutical sector, or like within that, if you take healthcare sector as together. So if pharmaceutical is an industry, okay, so for example, biotechnology or medical device or medical supply, hospital, these are different industries within the healthcare sector. So this is the difference between the industry and the sector. So we need to see closely whether the industry is affected or the sector is affected. If we can move into the different, because when you are within an industry, okay, you have prospects with the competitors going into network. When you are in a sector, you have higher possibility, the company has higher possibility to go into network with other industries within the sector. Now, how to do an industry analysis? You need to see what is the industry's attractiveness. So in the beginning, I told about the company's relative position in the industry and what all you need to check in terms of company versus the industry's average. Now, within the industry, what you need to check is the market size and the growth, and the most importantly, the seasonality and the business cycle. Most of the industries have a business cycle. it has some kind of seasonality. There will be some kind of a season, and there are some business which doesn't have any season at all. For example, medical industry will, that most of the people, the medical staff are working so hard during this period because now this is the time when they have to work. There is an impact, but most of the time, or the previous year, they never had anything like this. They are getting into a lot of deals. Okay, a lot of health care deals are coming up. A lot of spending is happening in healthcare. A lot of expenses are happening. So within the healthcare industry, there is a massive change right now with the business cycle. And if you see in another aspect, if you see tourism, for example, in terms of seasonality, there is a season when you travel. Usually, most of the time, the summer is, you have more activities, vacations planned. So you will have more activity in the tourism industry during that particular seasonality. Economies of scale, like how good is your average price when it comes to the production, because every time you produce a bunch of products, and it is important for a company to reduce its economies of scale by having, to produce more with lesser cost. So what is your economies of scale? What is the industry's economies of scale? Does it have a very attractive economies of scale, or does it have a economies of scale? Okay. And then you also need to see what is the industry profitability. Some industry are very profitable. For example, you take a real estate, for example, some of the companies like trading companies contribute to a big revenue, but sometimes, some companies will not generate much revenue. So you need to see what is the profitability of the company. There are many companies here in Qatar as well who are holding groups, okay, which has different industries. And it is like you are spreading your risk across different industries and different companies. So if you have a problem with one industry, you can switch on to and focus more onto the industry which generates more revenue. So industry profitability is very important. What are the technology and capital requirement? In economics, labor intensiveness and capital intensiveness are very important. Technology, you spend so much of money. Capital is flown in the technology intensive products, but labor intensive, you have more, you focus more onto the skill of the people. Okay. And what are the emerging opportunities and weaknesses within this industry? Okay, so now with the COVID-19 situation, now if you see these 6 aspects of the industry analysis, you as an investor can see, oh, this particular company, okay, in this particular industry has a prospect because there is a need in this situation. For example, pharma is a growing biomedical or, medical supplies. These kind of industries within the sectors have a huge impact during the situation. Online teaching, you have seen how much Zoom has made money, how much Netflix has saved money, right? So when people went back to their houses and started working from their homes, okay, these kind of online platforms, okay, have boomed, okay, and they are issuing more shares now, and they are going into more share issues and raising funds, and they're also making more profit as well. Okay, even medical companies, telemedicine, all these are booming. But on the other side, you see cinemas, for example, it has greatly hit. Restaurants for some extent, but you have to use different kind of strategies for, booming as well. So these 6 aspects, if you see it in terms of your industry and read it along with your company's performance, you can make a lot of conclusions about, okay, whether this company's share has a good prospects of investment. Now, let's go to the last and the 4th indicator, or the main one, which is the national and international economic outlook. Now, I talked about the company's 2 analysis, which is the company's financial analysis and the future prospects. I also explained about the industry analysis and the sector analysis. Now, the last one, which is the biggest bird's view, is the national and international economic outlook. In this aspect, I showed you one beautiful figure which has different factors like demographics and political and economic and everything. But ultimately, economic indicator is the most important factor, because behavior of the economy is contributed by all these factors. These factors, demography, sometimes, some years back, we had blockade. It has affected the economy. Now we are going to have FIFA in 2 years' time. that will affect our economy. So everything, every event, and every demographic, every political situation, tensions, bilateral relations, you know that, like in the beginning of last year, we started hearing problems about the US having problems with China because of Huawei and Google. And then it went into strained bilateral relations between China and the US. Now, what has happened? All the production related to the US companies got affected. They started exiting China. And even after COVID, we have seen Tesla has exited from China. There are many other companies also exiting from China. Now, this is an indicator. This will show that, okay, now you need to be domestically stronger. Now, this is what we learned from our blockade as well. When something has happened, we learn to be more stronger. We have Balagna coming up to, fulfilling our needs as consumer in consumer goods industries. We have seen many logistic companies. We have seen the Doha port. We have seen many companies standing up domestically to rise up to the situation, right? To rise up to the situation which has choked our neck, okay, which is a blockade. We have seen the companies coming up. So domestically, it has an impact. The political situation has an impact. Major trends, major fashions, major change in the market, it affects ultimately the macroeconomic situation. Now, what is macroeconomic situation? What is a macroeconomic indicator here? This will show the overall health of the economy. I'm going to dwell more onto that, and I'm going to show you what are the major macroeconomic indicators which you need to look at. I just want to set the scenarios so that you will understand, okay, how the macroeconomic can help you to understand the economy and later the industry and also your businesses. How macroeconomic helps the consumers. For example, for a consumer like you and me, I want to know how easy it is to find a work, okay, how easy to, buy goods and services in the market. Okay, and businesses also use macroeconomic analysis to determine whether it is a right time for investment, it's a right time for expansion and production. Government also look at the macroeconomic indicators for budgeting, for taxes, for spending, decide and to make decision on interest rates, and finally the policy decision. Now, as investors, okay, what will macroeconomic indicators help us to? Macroeconomic indicators will help us to make decisions at the right time and where to invest, okay, what is the right time to invest. Now with this, let me go into what are these macroeconomic indicators. So there are three types of macroeconomic indicators, and we call in economics as economics terms for these kind of macroeconomic indicators. There are three main types: leading indicator, lagging indicator, and sometimes coincident indicators. Now, these leading indicators, okay, helps us to forecast the where an economy might be heading. So there might not be an event, only there is some smell of some event that's going to happen, okay? But before that itself, the indicator will show you, okay, how big this event is going to be and how it's going to affect, okay? And this is like a leading indicator. It will be even before something bad has happened or something good has happened. It is in the forefront, and it will show you where the economy is heading into. And they are often used by the government to implement policies because they represent the first phase of the new economic life cycle. Now, what are these top leading indicators? So first and the most important leading indicator is the stock market. Now, stock market is considered as a very good predictive and leading indicator of economic health because the stock market people who are here, okay, they spend a lot of their time assessing the health and companies of the economy. So they are spending almost every day, almost every moment of their time, okay, and watching out to the economy and the company, and they're very sensitive to the news and to all the things which are happening in the economy. So they are well placed to judge the future growth. So stock market is one of the top leading indicators for macroeconomic indicators. Now, what will the stock market tell you as an investor? For example, a rise in the stock market index, Okay, it gives confidence, it indicates that, oh, there is some, confidence in the future of business. That means there is confidence in the economic growth. Now, when you see a decline in the stock market index, this also gives you a message as an investor, because now that will tell you that, okay, people are taking out money from the market and they are not thinking that, okay, this is not going to be the right place. So some kind of a panic is there. Now, the problem is with this stock market indicator is that it's very speculative. It's based on expectation, like, for example, you can see the dogs and the pigeons and, these kind of cute animals, like they are very sensitive. Even an earthquake tremor which happens somewhere, they will be suddenly, they know it well. Then even before we know it, okay? And they are very sensitive to footsteps or, these people, okay, they are very sensitive. Stock market index, they're very sensitive. They know it well. Okay, suddenly they withdraw, suddenly they put in a lot of money. So this is an indicator, but is it a right indicator? Some of you will not agree because it is based on speculation. It's based on expectation. For example, maybe the speculation is not true, okay, because it is different from the true value of a company. Maybe the company is doing really well and the company's performance is good. Suddenly there is a, there is a scare and suddenly people are withdrawing money. Now, that's why we see a lot of undervalued and overvalued stocks because of this panic, because of these expectations and speculation. Sometimes there can be bubbles, ahead of some market crashes, which can create a false sense of optimism about the state of economy. And this happens when traders and investors ignore other macroeconomic indicators and gets, swept along with the bullish market environment. Now, this is one scenario of indicator. The second scenario is house prices. Now, the real estate market, okay, it's very, very prominent in advanced economies like the US. And that's why the housing prices are a good indicator in the advanced market. In this market, what happens is that housing is a big thing there. And it can form, okay, a sense way in advance, even before the economy, and inform what the state of the economy will be. And a decline in the housing price suggests that will suggest and will let you know as an investor that number of houses, that is, the supply of the houses is greater than the demand of the houses. So people are, like, okay, there is a big surplus there. So now the price has to come down. So that shows that, okay, people may not be having money. Okay, that means shows that there is not much of money available with the people, or people are not confident. Okay, this kind of sense will be there when there is a decline in the prices. Now, this could be because, and sometimes the other way around also, like suddenly there is a big demand and the prices are going up. And now this has happened, and we should not leave this indicator just easy as it is, because in 2009, okay, we know about the Great Recession which has happened. It started with the mortgage loans and about the house prices. So it just blowed up. It just became a big bubble. It became inflated, and suddenly the whole sector, and then the economy, and then the world economy, and then each of us got affected by it. So this is a big and a best prime example of the impact of housing market on the economy. Now, the third indicator in the leading indicators is the bond yields. Now, the bond yields, it's thought to be a good leading indicators, but it's important to note that the entire market is just based on these investors and the traders' expectation of future economic circumstances. So the best way to use this bond is to see the yield curve. Okay, so this is one way of indicator. So when a bond's yield is this is the income. Okay, this is the bond's yield means, it is the income that a trader can expect to receive in return for buying and holding a bond. So the performance of short-term bonds, okay, that is maturity is up to 2 years. It's directly usually impacted because of the central bank decisions and the interest rate expectation. Now, while the performance of long-term bonds, they are usually, okay, with maturities longer than 2 years, they are also impacted by the interest rate, but also factors like inflation and economic growth, which can be, longer to come into effect. Now, when the economy is growing, positive upturn can be expected as a result. There will be a result of higher inflation. And when the economic future becomes uncertain, now the yield curve again flattens. So now this is an indicator. So the bond yield is all about these traders and investors' expectations. So this, when you want to do an investment and you want to look at the macroeconomic indicator, you can look at the bond yields and to see like whether there is, some kind of an outlook which the bond yield is giving. But now it's very important that you compare between two bonds, because the bond qualities are different from one to other. Okay, there can be, for example, two bonds with two different kind of quality and two different yields. So you need to compare it and see whether, how credible is this bond yield curve analysis. The fourth factor is production and manufacturing statistics. This is one of the key, but not used in almost every company, every countries for investment analysis, but this is one of the most important. And if you collect information about production and manufacturing statistics, this will give you a lot of insights, okay, about how the economy will be looking. Now remember, these all aspects are leading indicators. This will show you where we are heading to, okay. Now, in production and manufacturing statistics, which is one of the quickest and like actually the easiest way to get where the economy is heading to. For example, when there is a production increase, when there is a manufacturing increase, output trends, it will surely have an increase in a GDP as well. Okay, so the GDP ultimately will grow up. Okay, this can be seen as, okay, there is a increased demand of something, a production, increased demand for a product, and thereby there is an increased production. And when there is increased production, that shows that, okay, there is an increased revenue coming up, an output coming up. So the number of manufacturing jobs will also increase because of the production increase. And it also tells how confident the businesses are in that particular situation. And if there is, increased number of hiring and increased number of, output, all this will tell you, okay, based on this statistics, like where the economy is heading into, whether it's going to be positive, whether it's going to be negative. And that's why when FIFA came up, okay, and we see a lot of constructions and a lot of jobs, a lot of people hiring. And even though, like we don't have this kind of, production index and we don't follow that, we can see at least through our eyes that, okay, there is something happening, there is something, the confidence is good, right? So production and manufacturing stats is very, very important. The fifth factor is retail sales. Now retail sales means, retail shops, the shops, the showrooms, these all comes under that. Now retail sales talks about the consumer's confidence. Okay, now consumer, if they are worried about the future, or if they are uncertain about the future, or if they think that, like, okay, I cannot spend this much of money, okay, the retail sales will get affected. Now, this is the data that monitors all purchases of finished goods and services by the consumers. Now, it is really important, like, for example, consumerism is a key or the basic of all business operations. Now, if consumer is not there, nothing is, there is no production, there is no revenue. So consumer, that's why it's called customer is a king, right? So consumption is the most important factor. And this can have ripple effect. When consumption increases, manufacturing increases, production increases, output increases, GDP increases. So retail sales, okay, are very, very important when it comes to, checking this. For example, when consumers feel uncertain about their economic future, they suddenly stop, purchasing, and they restrict only to things which are needed, right? Like exactly like in the situation we are now. Are we spending money on big things? Are we buying cars? Are we buying big houses? Are we moving to big houses? No, we are becoming more defensive, right? In terms of investment. So during these periods, you need to watch out for defensive stocks. And now these are the companies who are producing necessities for the consumer. Okay, so these are the companies who produce basic need products. Okay, so these are the companies which will look only for food and utilities, these kind of things. So they will tend to outperform in the market. So, people will not go. That's why you saw 2 weeks back, you might have seen, Aston Martin CEO was fired from his position even without him knowing. He read it from somewhere, okay? So people will not go and buy an Aston Martin or a Bentley now, okay, and book cars, because that's not the prime need now. They're becoming more defensive, right? So retail sales is one of the key elements which we need to look into to see what's the prospect of the market. The lastly, when it comes to the leading indicators, is the interest rate. Interest rates can tell us stories. So that's why whenever you see, the US market, you can see that there are many companies, like in the US market, in Fed interest rates and, interest rate fluctuations matters a lot. Okay. For example, actually there is argument between people whether interest rate is actually a leading or a lagging, because sometimes because of the economy situation it will become a lagging indicator. Sometimes it can be a leading indicator because after this movement other things change. For example, now interest rate can be a lagging because it can be based on some of the decisions, some of the incidents that has happened in the economy, and then suddenly the central bank has decreased the interest rates. Now, when central bank reduce the interest rates, okay, there is an impact on the consumer spending. There is an impact on consumer saving, okay, and the same thing affects, when they increase the interest rates as well, okay. When they increase the interest rates, okay, maybe, your loans will get costlier, okay, so that is something important. So people are, but also your deposits becomes, beneficial. So this is one aspect. So interest rate can tell you stories, okay. It can tell you, it can indicate whether it's going to be a good way or a good path for the investors or the other way around. Now let's talk about the lagging macroeconomic indicators. Now lagging macro indicators reflects what has happened in the past, okay, and because of that this indicator looks like this. And these kind of indicators only change after a trend has been established, okay. Now for example, because of the situations and low production and low consumption and low trading and everything, what happens, the GDP will get affected. So it lags after a specific time. So, but that will also give you a trend. For example, the first and the most, lagging indicator is the GDP growth rate, okay. So in this GDP growth rate, the GDP growth rate will tell you stories about, okay, whether it's going to be a recession coming up or whether it's going to be a good future coming up. Okay, for example, for a fact, like if the GDP is consecutively negative, at least for 2 quarters, for sure there is a recession coming up. Okay, so this will tell you whether there is a future for your investment, whether you need to be cautious. Okay, so this is something very important to look forward to. Now GDP is a lagging indicator because it is connected to many of the factors which I just explained, the retail sales and also the the production and also consumption and the other aspects. Now the second aspect of a lagging indicator is consumer price and index and inflation. Now, consumer price and inflation is one of the most important factor of a country. It is a lagging indicator because it results after the economic growth and a decline. Okay. Now, during periods of economic growth, for example, there will be inflation as well. There will be increase in the prices. So the consumers will like to spend, and also the prices goes up as well. Now, higher rate of inflation can actually impact the country's currency, okay, but decreasing its purchasing power and make it more expensive for the buyer. But it's not a bad thing. Inflation is not a bad thing if it is benign for the customers. But there is something called deflation as well. Okay, for example, Japan for many years since their policy changes in 1990s, they are in deflation. That means prices lower, the general price is declining, right? And there is currencies. The next aspect of price index and inflation is that it can even go below zero. It can go below above 0%. Okay, but it can have positive and negative impact. Now, for example, if it goes below zero, that means it's good for the consumers. That means, you know, the prices are declining, but it's not good for the producers. Inflation, the production will increase and it contributes a lot for the output. So you need to watch out for consumer price and index. The third aspect in the lagging indicator is the labor market statistics. For example, you all know about these days we are reading 20 million, 25 million people have lost jobs in the US, right? So unemployment rate, okay, also talks about where the economy is heading to. Okay, it's a lagging indicator because, you know, on one aspect, it's based on the production, it's based on the retail sales, it's based on many things. But on the other side, it will tell you whether this economy is in the right direction, whether it's going to fall, whether it's going to have an effect for a long time, okay? And if the employment rate falls, it means that the business have finally given up hope, okay? And the situation is going to be like, you know, a dull situation, at least for some time. So that's why they are laying off their employees. Okay, now we all experience a layoff. Okay, so this will affect in the unemployment rate. When unemployment rate increases, that shows that business lost confidence, and the people also doesn't have money to spend. Okay, so they will wait till for some time to, you know, for the market to get up. So labor market statistics are very important. Commodity prices, for example, every businesses, every production, every companies, you know, which produces goods or services, there are some main commodities. For example, wood, iron, oil, for example, plastic, you know, steel. These are, you know, like main commodities which we use as a base, right? So if the commodity prices are increasing as well, that also shows an indicator, okay, how the economy is doing. So, for example, if there is an economy-wise increase of demand on wood and oil and iron and all those, this shows that the economy is growing. And these supplies, you know, like, for example, because there is a construction happening, and because the construction is happening because there is a FIFA happening, for example. So these are like, you know, indicators to show that the economy is booming, and there are, you know, like a lot of commodities out there. But there are some commodities like gold, no matter whatever the situation is, gold is like, you know, going up. This is something scary. This is something which you need to watch out, not like other commodities, because gold is completely different. It has a different way of functioning. For example, gold's price will increase during economic downturns. It will not increase when the situation is good, because now people have a habit of investing in gold, and they have more trust in gold than anything else. So what people do, people will go and invest in gold, okay, when they feel scared, or when they see that, oh, other investments are not good. So gold prices will go up during economic downturn. And that's because gold is considered as a safe haven asset, you know, like everyone likes it and everybody wants to invest in gold. So the investor consider, okay, it as a store value during the period of economic uncertainty. This is considered as, you know, like everyone will go and buy it. So if the prices of gold prices are rising, it can be a sign that economy is slowing, okay? And investors are seeking out more stability. And if the prices of gold are declining, it is a sign that investors are moving their money into higher risk assets. So this is the language of gold movement, gold price movement. So this is completely different from other commodity prices. Now, the last factor is the currency. Now, currency strength is a reflection of the health and the stability of an economy, because a currency price is based on how buyers and sellers perceive its value. For example, based on the demand and the supply, and everything is based on like that. It's a lagging factor because the currency value will change to reflect maybe the political situation, the economic circumstances, and when there is significantly uncertainty or change, the instability plays out across the nation's currency. When there are sudden situations of problems coming up or bilateral issues coming up, it directly hits the currency first, okay? So this is also, you know, an impact, okay, which can finally come as a lagging indicator. So these are the top lagging and leading indicators. Forgive me for this heading, top leading, it should be top lagging indicator. Now, the last indicator of these three types is the coincident macroeconomic indicator. Now, coincident macroeconomic indicators are generally along with the lagging indicators, but it comes in between, you know, like before an economic shift can happen. So this is how it will look like. So the leading factors, based on many incidents, the leading factor will tell you, okay, and show you what will be the, you know, the future. And in between, there can be some coincident factors which can happen in between. For example, sometimes, you know, real-time GDP can be a coincident factor. Sometimes, you know, unemployment in between can be a coincident factor as well. So leading, lagging, you know, in the cycle, it can show you many aspects. Now, where to find these economic indicators? So in the beginning, I told you about company, you can find the financial statement, industry, you can find the industry's financial averages. And where can you find macroeconomic indicators? Usually, macroeconomic indicators are published by the government and the supranational bodies and even NGOs as well. You can look at it. World Economic Outlook, IMF, World Bank, these all give world outlook. And even these days, they are giving, you know, a lot of webinars as well, which tells you about how the outlook will be as well. And most macroeconomic releases happens on specific dates, which means that the investors can prepare for the release. You can just join in and see what the market volatility will be. Now, how will the macroeconomic contributes with the microeconomic aspect? For example, this is the factor, macroeconomic factor, which shapes the economy, shapes the company, shapes the industry. So it has a very significant influence. Now it complements the microanalysis, okay, because it will tell you what will be the environment of this company in the future, okay, or where it is, you know, whether it's going to be a favorable or whether it is going to be a difficult one. And it's also in help in prediction of the future, and it helps in studying the business cycles, which impacts the performance of the companies. Now, so to summarize, as an investor, being informed is the greatest power, okay? So haphazard, unstructured, not backed by data, and untimely decision can often fail you. And fundamentally, it is important to have specific understanding of a company and also understand the environment in which the company works. And in this regard, investors need to know fundamentally a micro and a macro approach, and they need to understand in that way. So microanalysis will help you understand the grassroots level, which is mainly the company's past, present, future. And macroanalysis will give you a wider angle about the environment based on the past, present, future. And you need to use both. Like when you are, like you need to use both, a mix of both to understand what kind of a decision you need to use. For example, this is like a road trip. Okay, so when you get into the car, okay, you will check into the dashboard and see what is the position of your car in terms of battery, in terms of fuel, in terms of air, okay? And while you drive, you will know the performance of the car. For example, what is a car's mileage, what's the speed, what's the RPM. So this is a micro aspect, okay? So when you look at it within the car, this is what you know, okay, this is what the car is, okay, this is the company's aspect. But unless your environment, that is the weather, road safety, traffic, etc., all these things which are not, if it is not favorable, the road trip cannot be successful, right? And that is a macro aspect. And especially in a time of uncertainty like we are in now, the macro aspect should be watched to make wise investment decisions. So with this, I wish you all the best to make informed decisions, be watchful, be prudent, and be successful investors. Thank you. Thank you, Qatar Stock Exchange, for giving me an opportunity to present this analysis ideas and to give a viewpoint from my side. Thank you.
Thank you very much.